2021 was an absolutely wild year. A lot of interesting things happened, to put it mildly. What about the environment made the market and funding peak in late 2021? Was this all just a bubble? Was it all just speculation? Christian, you were talking about some big highs there.
Yeah, it's absolutely clear that the market in 2021 was an outright frenzy on asset prices. The monetary policy undertaken by central banks and further stimulated by governments and really encouraged to counterbalance the impact of COVID-19 has seen asset prices only going one direction, and that was up. Equally too, with the end of with both, I mean, already triggered by the lockdown, what we've seen is that the housing market went into a direction that nobody anticipated when the COVID crisis first hit. Housing prices persistently increased, and what we've seen is that people moved out of city centers. We have seen a rush to bigger houses, to accommodating working from home. So almost counterintuitively, we've seen this part of the market increasing throughout the crisis. It's almost evident that this rush in 2021 wasn't sustainable, and from the fact alone that we faced a severe labor shortage, it's almost certain that inflation was on the horizon. In the US alone, it's estimated that the labor market lost close to 500,000 people that never returned after COVID-19 lockdowns, and that's on top of the people who have passed away throughout the pandemic. The war in Ukraine made the shortage of supply and the supply chain the supply chain disruptions even worse. So inflation was on the horizon, and it's almost fair to say that we triggered the brakes a little too late. It's very clear that in 2021 the asset markets only knew one direction, and monetary policy was still extremely loose to stimulate the economy.
Absolutely. Gennadiy, can I get your opinion on this around around 2021? Why was it all just speculation?
Yeah, sure. Well, a series of monetary policies, including cutting the Fed fund rate and quantitative easing employed by the Fed back in 2020 to stimulate the economy during the heat of pandemic and injected the needed liquidity in the markets, all helped to boost the economy. And generally it takes anywhere between 12 and 18 months to see the full impact. So now, fast forward to 2021, we see the strongest economic growth in the US since 1984, somewhere around 5.96%. Now, cheap money, low unemployment combined with the growth in personal income created a foundation actually for the perfect storm. And a lot of training that we have seen in 2021 are less fundamental, but rather highly opportunistic. And actually, we've seen quite a few funds were caught in this game. And look, let's face it, we all remember the GameStop back in summer 2021. I mean, being massively short gamma in a rising market is a tough place to be, and some fund felt the real pain of it. So the lesson learned is importance of understanding and actively managing the risk, and definitely a possibility of the tail impact.
Absolutely. What's changed since then, though, in terms of trading strategies?
Sure. Well, let's talk about some trading strategies. So we talk about high rates, high inflation, the war in Ukraine, the impact of energy sector, especially in Europe, and other world sort of geopolitical and economic events. They're all laying solid foundation for macro hedge fund to do quite well. And it's especially true for systemic macro strategies that often express the view in the market by structuring trade using various asset classes. The valuation here, it's actually interesting to notice the valuation here doesn't come usually from model complexity, but from the liquidity standpoint and capturing and reflecting specific market conventions in the valuation process. For example, there's very specific terms for Brazilian market. So talking about systemic macro strategy as example, it really starts from a model generating a flag, and this flag can be expressed as certain number of standard deviations. And the next step is evaluating a particular trading theme. So structuring the deal the most cost-effective way is the next step, which really includes evaluating the funding requirements, local liquidity in the market. And so once a trade is structured, is executed, booked, settled, and risking. So that's kind of the flow. And finally, from the risk perspective, the funds are looking for various cuts of VAR. Usually it's not a single VAR, but multiple cuts. Could be parametric and historical VAR or combination with Monte Carlo, and variety of stress tests, including standard stress scenarios. Aside from the global macro and systemic trading, so to say, we observe shift to fundamental trading in the credit space, and especially among the distressed credit funds. And they often come with complexity, with a pretty complex cash flows, which include bonds with various terms of sinking provision, peak terms, various put call schedules, multi-step coupon, floaters, multi-flow structures, etc. Obviously, that creates a lot of demand of properly capturing terms and conditions, but also on the modeling side. One thing I would like to mention is the demand and the activity that we have observed in exotic FX and volatility product space. And these are the products with a very complex P&L profile. Just to name a few examples, we've seen our clients asking for, or potential clients for triple digital FX option, digital double knockout, etc. Some volatility swaps on worst realized vol. So the complexity is here, and demand for modeling, for properly capturing the terms and conditions and the modeling those products is increasing. And then, so that brings another question that from modeling perspective, FINCAD enables our client to really fine-tune the modeling approach, to essentially to pick and choose the right approach depending on the product or current economic conditions. So the purpose of any model is really twofold: is explain and predict. And the various modeling choices, we've seen the clients running the P&L attribution, which decompose the P&L into risk drivers. And what's interesting to note is that this approach not only allows for the funds to see what are the drivers of the P&L, but also it's a good test of the model. Typically, the smaller unexplained P&L is observed, the better model works to explain the P&L movement of a particular product. So I'll give an example. Back in 2020-21, during the low rates environment, in some market we've seen negative rates, so the models just stopped working. For example, we've been switching from log normal to normal model as a good example. And our flexibility, fully customized environment within Enfusion allows clients to do just that. And what's important to note is that they can do this in some cases without even touching the code. It's all part of configuration. Another example is within the FX option space, where the clients can actually choose between Black-Scholes or Van Vogt model. So the flexibility of choosing the model, of fine-tuning your approach, how you to the risk management, that's a tremendous advantage or leverage that we provide to our clients through our partnership with FINCAD. And I just want to highlight, again, our partnership with FINCAD allows not only to work together to deliver risk and pricing solutions to our clients, but also work creatively to define various pricing schemes using existing product universe. And just quick examples, sometimes we have quite exotic complex products which we'll ask to model, and maybe there is not a single function that allows to do that. And that's where our partnership really come together. We work through the problem, try to find what solution, how we can use various perhaps multiple steps of the process to deliver the proper P&L end user.
Very good, very, very well said there. Christian, I want to just take this back a little bit to, we were talking about some of the speculation in 2021. What from your end, aside from some of the elements that again has been brought up there, what has changed in terms of trading strategies since the end of 2021 from those peak highs?
Well, I think investors are definitely under stress to meet and make their returns. I think risk management has become extremely important in these days. We've seen the pension market in the UK being heavily disrupted with the trading of gilts, which was a combination of market, collateral, and liquidity risk management. I do think this really brings to mind that that modeling and paying attention to the detail is exceptionally important. So what we've seen there is quite extraordinary, where there had been a very strong feedback loop on gilts falling, triggering further collateral calls against derivative position, which led to pension funds having to offload even more gilts or trying to repo them out respectively. We've seen that pension funds rush to their sell-side counterparts to amend their CSA, move from pure cash CSA to dirty CSA, to being able to post both gilts as well as convertible bonds as collateral against the derivative positions. Overall, the modeling, the race to being extremely cautious around modeling is really at the forefront of the thinking in the market. I do think a lot of institutions are very cautious, not trying to not make the mistakes throughout the crisis in 2008. We see a lot of attention in risk management, model risk management across the industry. And I do think the element of FINCAD not only providing our analytics into the market directly, but equally to working extremely closely with our partners. And I think Enfusion is a prime example of partnership which has worked extremely well from our perspective, where we found that embedding our analytics, empowering Enfusion to really bring this analytics into the hands of their customers, has set up this partnership apart.
Cool. I see where we are at the moment in terms of the market as a whole, some of how we've kind of got there. But I wanna bring the conversation round to a bit of technology. Now, the large industry players are finally, and really quite at an accelerating rate, starting to use cloud and modular-based platforms, which traditionally was always, the more nimble, smaller fintech players. That was always their competitive advantage when it comes to speed of adoption. And again, I'm going to come to you first. How can fintechs remain competitive when it comes to speed of adoption, now that the big boys are leaning over and copying their answers?
Yes, thank you. In fact, Enfusion is a fully cloud-based solution with single or multi-tenant models, which effectively eliminates the need for any software update or software maintenance, which is a tremendous leverage to our client. Our partnership with FINCAD empowers our client with a robust analytical library capable to handle a variety of complex products under various set of model assumptions and market conditions. But what does it really mean? Being the best of the breed means not only providing spectrum of various analytical multi-asset solutions and extensive libraries, but also being able to quickly adapt and respond to the client's needs. And one of the examples I would like to bring is when clients come to us and try to model something that we don't have a function available on fly. And that's where our partnership, our collaboration, and our brainstorming come together with Enfusion. We're trying to build a framework of the existing functions, how we can make that product work from both P&L valuation and risk perspective. The other point I would like to bring is many of our clients demand a high level of precision. And just to mention, risk management is not cash reconciliation, and the answer is not always binary, and often, test the model outlook to various benchmarks. Ability to work with a FINCAD team effectively and efficiently on finding different solutions, enhancing our models to handle more complex structures, and continuously calibrating models to the market to ensure tight fit help us to effectively address clients' needs and deliver solid analytics across multiple asset classes.
Now, Christian, off the back of what Jenna mentioned there, going back to around the kind of competitive edge that fintechs had when they were kind of the only people who were really cloud-based. What else can they do to remain competitive, especially when it comes to speed of adoption?
Yeah, it's very clear, and we see this across the client and partner spectrum, that cloud adoption is not an optionality anymore, but key to stay competitive in the current market environment. Looking across our OEM partners, we find that those who have embraced cloud technology fare extremely well, and Enfusion is the leading example in the hedge fund industry. For ourselves, we see a unique value proposition offering combining best-of-breed analytics with cloud-native technology in two ways. First, we embed that into our development processes, and our CI/CD philosophy is built on a vast suite of unit test cases across our build systems with automated software regression, and that is completely cloud managed. We absolutely have to make sure that we can respond quickly to our client and partner demand. Second, we're also leveraging cloud to bring our products and services to our client through cloud APIs, really supplying analytics as an industry utility. On top of that, our libraries are not black boxes. They come with transparency tools and utilities that ease the internal consistency and model validation requirement, whether that is tracking behavior of Greeks, benchmarking against results from other available models, checking to alternative numeric or methodologic approaches. We tend to be very transparent in how we engage. Our libraries are also very accessible. Really, the buyer's journey is top of mind with whatever software we produce. You can program against our interfaces in Java, .NET, C++, and Python, and other programming languages. And very often, results can be locally reproduced in Excel, JupyterLab, or VS Code, which means Excel and Python are an ideal tool for validation and testing. Being able to run analytics locally, as well as offloading calculations seamlessly to cloud and grid computing infrastructure, is critically important. Last, I want to close out that working with our partners to provide a whole product proposition is critically important. Enfusion offers market-leading cloud-native technology, which enables FINCAD to significantly expand our addressable market. And we're very proud to work with Enfusion on this journey for many years now.
Thank you all so much for taking the time to speak with us today. First of all, Christian, where best to find out more about yourself and FINCAD?
I think the best place to go is to our website at www.fincad.com. I would encourage any viewer of this webinar to reach out to me on LinkedIn, and I'm very happy to engage with all of you personally and or direct you to a very trusted resource in my organization.
Excellent, excellent. And again, where best to find out more about yourself and Enfusion? Where best to reach out?
Yes, totally. I totally support what Christian said. I think between the website, our website, company's website, and LinkedIn, you'll find probably most of the information. Any questions you have, please feel free to reach out to us.
I've been your host, Ali Paterson. Thank you all very much.
Thank you very much, Ali.
Thank you.